Hi, Nick. How's that? Yeah, better? I can't hear you at the moment.
Hi Nick, can you please try to unmute yourself?
James, can you hear me?
I can. Can you hear
Hello?
me?
You can? I can't hear you.
You can't hear me. I can hear you.
You can hear me, you're nodding.
Yeah, I can.
Okay.
Almost there.
Uh,
I'm not saying it's well.
Disabled. I have no idea if you can hear me, James.
I can hear you.
Put your
Yeah.
thumbs up if you can hear me. Great. All right. Thanks.
Don't know how we're going to ask you questions, but we'll do it now. Cool. We'll work it out.
For the record, I can't hear you.
Yeah,
That
I'll get
matters.
Eamon to message you. Okay, it's 11 o'clock and we should may as well get going. So my guest this week is Nick Brind from Pally Capital Financials. So we'll be talking to him in a bit. But first, a few bits of news to get through. And a reminder that as we go along with this, if you've got any questions, just put them into the chat function of YouTube, please. So 4 things I picked out to talk about, which is quite unusual and quite a short week, but there we go. Foresight Sustainable Forestry first. Now, this is a fund that is really designed to be fairly boring. It's sort of, timber takes a while to grow and the returns take a while to come through. They obviously, when they were establishing the fund, bought some mature plantations and things, so that gave them some income coming through earlier on. But nevertheless, it was always going to take a while to get going. And it's not really obvious why the share price cracked and it went to a big discount. But it did, as you can see there on the chart. It's not been going very long. So from an IPO in November 2021, it managed to put together a portfolio of about 12,500 hectares of land, planted 1.4 million trees. There'll be more than that now. And they've been harvesting some of the timber from the forests that they have got in place already. And then the other chunk of the income story is carbon credits. So they've got £2.7 million worth of carbon credits as well, because they are planting new trees and that attracts a credit. As I said, it's not going to be exciting to start off with. And so the NAV return since IPO is only been 0.3%. So it would have been more than that, but there has been fall in the price of the timber and the land. But as I say, the share price just sort of dived off a cliff and went through to 60p. So they've now been subject to a bid. There's an outfit called Avon Park, who's a US firm, have bid 97p a share for the whole company. They've already got some UK forestry interests, about 7,000 hectares worth. The board was frustrated that it couldn't grow the fund anyway, so I think that means that they were more inclined to sell out with that combination of the discount. As far as Averon goes, and as far as the whole thing goes, I mean, if you read my Citywire article last week, it was talking about biodiversity. One of the things that Foresight has been trying to argue for, alongside some academics, is that wood and carbon credits should be included in the UK emissions trading scheme. And if they did that, they think the value of these carbon credits would go shooting up. Obviously, that makes the whole thing a lot more valuable. And that means that Averon's got itself a bargain. And there's a reason for doing that, in that planting more trees is obviously helpful for climate change. It has some other benefits too, so stabilizing soil and stuff, but that's the main thing. And the paper, if you go and read it on you Google it and read it, is saying that if they did that, they'd bring a lot more land into the forestry generally, and what stuff would get planted up. The trouble is, and I alluded to this in the article, it's that they're just planting conifers, and they're non-native conifers as well. So from a biodiversity viewpoint, it's pretty much dead. They didn't have very much mixed broadleaf woodland, and I think they're kind of making the problem worse from a biodiversity point of view. So for all the sort of nice things that they were saying about, we think looking at what we can do with our estate in Scotland, I think most of it is just sort of monoculture, non-native conifers. So I think there is a question here about whether the climate benefits outweigh biodiversity loss. I know it's not going to be a problem for our sector because this bid's almost certainly going to go through, but something is that we ought to be bearing in mind, I think. Now, batteries, Harmony Energy Income. We know that one has been a problem alongside all the other battery storage funds. It pretty sort of cracks at the same sort of time as the Foresight Forestry Fund did. But that discount's far, far wider, so it's almost 50% now, and that's with a slightly narrowing discount recently. It's not very big, and obviously I wanted to make it an awful lot bigger, and this has killed the chance of doing that. So if we go back to February, that's when they said, here's a trading statement for the year to the end of October, which is our accounting year. And revenues are going to be a lot lower than we were hoping for, and lower than they were in 2022 for this sort of like-for-like basis. So we've been through the reasons for this before. We talked about this regression, but basically there's been increased competition, more batteries coming on stream, which has driven down revenues for some contracts. Power prices have been a lot less volatile. So if power prices are volatile, one of the gains for these power things is to buy the energy when it's cheap and then sell it and store it and then sell it when it's expensive. But there was another big chunk of problem, which is the national grid wasn't using batteries in its balancing mechanism to try and balance the frequency and the load on the grid. And that was because it had software issues that were going to take a long time to resolve. So on the back of all of this, Harmony postponed its first quarterly dividend. And obviously the share price died. Then when the results came out, there was a statement in there saying, we've seen the size of the discount. What we're going to do is see if we can sell one or more of the assets, try and prove what the NAV is. And then if we manage to sell anything, we can reduce the gearing. And then if there's anything left over, we can buy back some shares. But what they said this time round, which is in an update for the 3 months to the end of April, is that revenues have picked up. 48% sounds great, but it's still not good enough. The NAVs had to be written down because of the forecast earnings looking down quite a long way. They've cancelled the dividend. There won't be any more dividends this financial year. All negative, negative, negative. But the positive in all of this is that it looks as though that they stirred up more interest than they thought they might have done for the battery assets. And so they're now looking for offers for some or all of the company's assets. So it could be that the whole thing just winds up. We get a bid for the whole portfolio and it goes, or the whole thing, or you actually get to take for a bid. So that's the sort of big news this week. The share prices have reacted, but not very much. And I think, if this is realistic, then it ought to go up more than that. Then the other thing we've got this week is a couple of new issues. It's been a long time since we talked about any of these things. Special Opportunities REIT, we've known it was been around for a while, but they've just been doing it under the radar. So they published a prospectus this week. They're looking for £500 million, which is quite a chunky amount of money, and obviously going to gear that up. So there's going to be, in terms of firepower, it's going to be quite chunky. For them, fortunately for them, they've actually got well over 100 million of that in the bag. They've got 4 cornerstone investors that they've lined up. And that's going to make a massive difference to whether this thing succeeds or not. I think that if they can persuade people that this is an opportunity, that they will get there. They might not get 500, but they could easily get sort of 3 or 4. Applications close on the 11th of June. It is open to retail investors. There's an offer for sale as well as a placing. The main idea of this is to take advantage of forced sellers, and to do so at a time when prices are already fallen by quite a long way. So they're saying that there are pension funds, there are people that geared up too much, there are all sorts of people that own property that are now going to be forced to sell it. And if you've got the cash to take advantage of them, you'll be able to pick up some bargains. So the team running it are all LXI, ex-LXI. So if you remember, LXI has just been taken over by London Metric Property. So I guess they were all out of a job, or thought they might be. So they've gone off and set up their own little firm. This is going to be a self-managed fund though, so they're not going to be running a separate management company. They're going to be actually working for the company. And so they're incentivized based on like an LTIP type thing, like some based on like a performance fee, but depending on how it's done. And it's done on crystallized returns, so actually having sold stuff, so returns to shareholders. All good stuff. The sorts of things they're looking for, they say it's high quality, so not really bargain basement stuff, but things where they think they can improve the yield on the asset by managing it better, and in sectors where they think there is generally faster than average rental growth. So the things they've listed there, things like student accommodation, industrial, still, data centers, definitely a big one, retail parks and budget hotels. There's plenty of that sort of stuff around, and they think they could get invested within 6 months. And actually, it's interesting that the other thing we saw announced this week is that London Metric has started to sell off the bits of the LXI portfolio that it doesn't want to own. I don't think it could be classed as a distressed seller by limited any such means, but there definitely is stuff around that they could buy. And they're not going mad on the debt with this thing. So they're saying loan to value ratio target of about 25%, which is not that too bad. Absolute maximum for 35%. And they think they can earn annualized returns of 12 to 15% a year, and maybe even better than that in good years. That's pretty punchy stuff. And I think most people would be happy even if they just got sort of 10%-ish. But dividends wise, it's not too bad either. So 3p in year 1, obviously, because it takes a while to get value established, and then 6p from year 2, and then a progressive dividend from there on. So yeah, I think actually this doesn't look too bad. And I've written an article about it, and I'll say to there, it's the sort of thing that I'm thinking whether I should have a stake in it or not. Now, the other one is a rollover vehicle for Aberforth split level income. So this is called Aberforth Geared Value and Income. So this is the 4th in a series of these things. So there's going to be lots of these names going out there, and I'm going to post them by tickers, so trying to get confused. Basically, the first of these was launched in 2000, and it ran for 10 years, and then everything else since then has had a 7-year life, more or less. It's just following the normal kind of Aberforth style, so investing in UK small cap, bottom 10% of the market by market cap, which is equivalent to what the sort of numerous smaller companies index is. It's slightly more concentrated portfolio than Aberforth smaller, so it's not identically the same. And this issue size is going to be capped at 222 million, which is the same size as Aberforth split level income as it is now. All right. Now, I did promise I'd talk about split caps and how they all worked when we got prospectus out. So here we go. So the first thing is, a lot of people turn up their nose when you mention split caps. I don't think that's all entirely fair. There are some good reasons why the split caps things went wrong, and we'll come to those in a second. But generally, the structure does work reasonably well. And the AGVI, the new fund, is a really kind of simple fund. So basically, it's a lot like having a portfolio geared up with bank debt, but using zero dividend preference shares instead of bank debt. And that bank debt, the equivalent bank debt equivalent is fixed rate because you know exactly how much it's going to cost you. But from a cash flow point of view, because you're not paying out dividends to those zeros, or interest or anything else, so basically from a cash point of view, you keep the cash within the structure, use it to earn more money, and then pay it all out at the end. So you get the benefit of compounding when the portfolio that you wouldn't have if you had the bank debt. We'd be paying out the interest each year. So that's, I say, one really simple structure. The other things you used to get, there's all sorts of combinations of things, but capital shares and income shares, well, basically you just split the returns of the portfolio so that the income shares normally got all of the income of the portfolio, so much higher yield than they would have done otherwise, plus a fixed redemption price. And then capital gets everything else, so they get the benefit of all of the capital gains in the portfolio. So their returns are geared by having the income shares there. So both sides kind of win, if you like. Lots of warrants and subscription shares. We haven't really got many of these left at all now. The only ones left outstanding are the ones that are with Cordiant, and because Cordiant's gone zooming downwards, they're well underwater. But so the right to buy ordinary shares at a fixed price or an escalating price in the case of Cordiant. So if you don't get in early, then the subscription price keeps going up. All of those things, they're complicated. They make the whole thing more complex, and from the FCA would get their knickers in a twist about it now, maybe, for some of these things. But they are understandable. It's just maths, basically. Where it gets complicated and where it went wrong is if you put bank debt into these structures as well, and it just creates more volatility. So these things, because they're designed to gear stuff, create a bit more volatility than you would have otherwise, and that's desirable. That's the reason that people want to have that structure like that in the first place. But obviously, bank debt also comes with the risk of covenant breaches too. So there are lots of things that you can trigger that would mean you have to pay the bank debt early. So basically, if you had a disaster and the thing just falls in value, the whole fund falls in value, then you breach the covenant and you have to break the whole structure right at the bottom of the market. Clearly bad news. And that's one of the things that went wrong with the split caps. But the real problem was that they were all investing in each other. And that's completely legal now. That was one of the things that changed immediately after that. So you now cannot have this sort of magic circle of things buying each other. So I'm kind of arguing here that I hope we'd see more of these things. We'll see. The zero dividends preference shares, like I say, it is a bit like bank debt, but they're issued at one price and redeemed at another. And they don't, as I said, they don't really come with covenants, except that they quite often have an asset covenant. So in this case, then, they're trying to protect the zeros from not being in a position where they wouldn't be able to get their money back at the end. So when they're issued, they're going to be issued with 2 times asset cover. So the assets in the thing will cover the zeros twice. And they're basically going to have covenant that says, we're not going to let you buy back shares or make capital distributions that would threaten that unless the zeros agree. So that's just the thing that's in the prospectus. The way that the return on these works is just a straightforward relationship between what they issued at, what they were going to be redeemed at, and how long have they got to go. And that gives you your gross redemption yield. And as the price goes up, the GRY goes up and down. So for AGVI, these things are issued at £1, redeemed at 160.5p, 7 years' time. That gives you a gross redemption yield of 7%. That's been also worked out to be exactly 7%. They're going to be issued in an 8:3 ratio. That's quite punchy. So there's quite a lot of zeros in the structure, far more than there were for the previous fund. And that will make the ordinaries a bit more volatile than they were in the previous fund. As I said, initial asset cover is 2.2 0 times. 7% is quite a good high hurdle to reach. So there's a lot of things going on here that make you think, well, do you want to do most of the ordinaries? They need 3% per annum growth in capital to get the capital stake back. If the thing fell by 10.3% a year, then they'd be completely wiped out. But they would be getting dividends. And here's a table that tries to explain that. So what you've got here is the capital growth each year down this side, and the income growth each year on that side. So it's just a question of thinking about, well, what is a realistic scenario for what the capital growth might be and what the income growth might be, and then plugging in them around the table. And I've sort of circled that. I don't know what's doable, but to give you a sort of an idea, this is the last 3 funds. It's not a complete disaster, but it wasn't great. So the total assets return, so that's the return on the whole portfolio, was only 2.8% a year. There's actually a mistake in prospectus. It says 20.9, but that's the whole number. So basically, for the whole 7-year life, it only went up 20.9%, and that was at 2.8% a year. That was barely enough, really. I mean, at the moment, the NAV of the awards is below a quid. So the only return they've had is through the dividends that they've had. So it's not fantastic. That's part of the argument for doing the rollover now, that the underlying assets, the companies have grown, the profits have grown. It hasn't all been a disaster. Basically, UK small caps are an awful lot cheaper than it was as it was launched. And that's maybe why you want to roll over now. But then also, if you look back at the previous 2 funds, the returns on those were a lot higher. And that might give you some comfort that the new ACV will actually do a bit better than as it did. So there you go. All you need to know about split caps. Obviously, if you want to ask me questions, please do so. But I probably won't have time to answer them now. Let's now talk to Nick. So good morning, Nick.
Morning, James. Thank you for having me.
Good. So you can hear me again as well now as well. This 3:15 is perfect. All very helpful.
Does help.
Yeah. Cool. So as usual, I'm going to let you fire away and just tell us a bit about the fund, please, and then we'll get some questions.
Yeah, very happy to. So I'll do a sort of elevator pitch, and then just drill down to some of the themes we're playing, and then yeah, very happy to answer any questions. So I suppose just very quickly on the team, there's 5 of us that sort of live, drink, eat, sleep financials, 24/7. We've got a few other colleagues that love the sector as we do. So we're really pleased we've got an in-depth team. Tom Dorner just joined us back in December. He was at Aberdeen Standard Life as a fund manager analyst, and prior to that, sell-side insurance analyst at Citi and Lehman. So he's been a great addition to the team and massively contributing. So going over the page, we run 3 funds. I sort of jokingly call them, skimmed, semi-skimmed, and full-fat versions of financials. Today we're focusing on that semi-skim version, being the investment trust. Just a little bit of history. It was launched 10 years ago as an income and growth vehicle, give you exposure, a low risk way of playing the recovery in global financials, with a yield at launch of about 3%, a little bit lower today. That dividend on average has grown about 5% per annum. I mean, it's been increased for about 7 out of those 10 years. It's never been cut. So, a good combination there. And, of the 3, as you can see, it's very much an equity fund, though we do have a small bucket to hold bonds, obviously to take advantage of opportunities as we see them there. And if you flip over the slide, just to really sort of drill down to, what is it we're trying to provide? We're providing that exposure to the sector. It's the second largest globally. it's giving you exposure to banks, insurance companies, diversified financials, and latterly fintech, which came to our sector this time last year. And you're looking at what we believe is some fantastic businesses in the sector. Many with sort of oligopolistic characteristics, some with a history dating back 150 plus years, and you're getting exposure to a lot of different trends, not just, even though when you think of it, it's a cyclical sector. Within that, we sort of try to drill down to some of the themes that you can take advantage of. So more recently, obviously, the attraction has been around the higher for longer, the impact of higher interest rates on margins for banks, on higher investment income for the insurance companies. But growth in asset management, wealth management, obviously increase in wealth, which the sector is benefiting from. Trends in insurance, which we'll come on to in a minute. You've got exchanges in there, rating agencies, and of course, some of these smaller fintech companies and obviously larger payment companies like MasterCard and Visa are very well known. So, what are we looking at the moment? Well, just to sort of touch on performance before we get into that, when you think about the sector. So, despite the perceptions of volatility, it's delivered, actually really credible returns over the last 10 years. So you're looking at around 9%, despite some of the headwinds around, the beginning of that 10-year period around capital and regulation, and then, low and negative interest rates. But when you look from the sort of, when we did a corporate action back in 2020 to extend the life of the trust indefinitely, and we'll come on to, the attractions of what that means, now from looking at the shares of the trust, you've had, close to, almost 20% returns annualized from that period. And, so the sector's actually done better than the wider equity market, whether you're looking at the FTSE All-Share or whether you're looking at the MSCI Acqui, at the bottom of this page. The other thing we often highlight when we talk about the trust is the performance of UK financials and UK banks. Always try and look at the sector. Don't look at it through the lens of what's happened with UK banks. UK banks had been a good place to be in the last 3 or 4 years. They performed really well. But over a longer period, you'd have missed out on some really, really good returns when looking at the sector as these numbers detail. So flipping over the page, then what are some of the themes that we're playing at the moment? Alternative asset managers, there's significant structural tailwinds there, which we'll come on to. Very topical at the moment about the demand for private equity and private credit. We think there's some those tailwinds will continue. We'll sort of go into that in a little bit more detail. Reinsurance, but also we could perhaps touch later in the Q&A on what's happening in the motor insurance market. We'll know that insurance costs have gone up materially in recent years, so the sector is benefiting from that. Emerging markets, long term, we've always liked the sort of India, Indonesia, the low penetration of financial services in some of these emerging markets. You can see strong tailwinds, but lastly, there's opportunities around reform, and we'll touch on Korea there. Small and big cap opportunities. You've seen in the UK that M&A has picked up quite markedly in the last few months. So if we can buy good companies trading at attractive levels, then there's a potential for some icing on the cake here if anything came through. And then banks, which are obviously critical, important part of the sector as well. I think here at this point in the cycle, we need to be much more selective. Concerns about commercial real estate, unrealized losses for some banks on their balance sheets. Equally, they're benefiting from the higher for longer. So we'll go into that. So on the alternative asset managers, why is it that we like these? I mean, to start off with, if you give a dollar of money to whether it's ourselves, whether it's a Fidelity, a BlackRock, a Schroders, or whatever, because of the daily liquidity of most funds that traditional asset managers manage, that money can go out the door the following day. The difference with the alternative asset managers, you give them $1 of investment, and that's locked up for 5, 10 plus years in their sort of semi-permanent vehicles. So you've got an asset base which is very sticky. The reason for obviously the flow is going into this asset class is returns have been by and large, very, very good. They're giving you access in some cases to parts of the investment opportunities that you perhaps can't access so easily in listed markets. And as these businesses continue to expand into other areas, not just pure private equity, but private credit, infrastructure, real estate, and so forth, then there's huge opportunities for these businesses to continue to grow. Infrastructure is probably one of the more latter ones where some of them have been growing. BlackRock, towards the end of last year, made a big acquisition here of buying GIP, which is a big global infrastructure player. And you pick the number out of your hat. The trillions of dollars that needs to be invested into this space. Again, this is an opportunity set that this sector, is going to benefit from as well. So we like that. On the next slide, reinsurance. So reinsurance, the bookie's bookie, as it's known. When you think about, you're taking out your home or car insurance, who does Admiral or Direct Line? They go and then reinsurance some of that risk. That might be with some of the big reinsurers like Munich Re or Swiss Re. It could be through the Lloyd's market or some of the Bermudan insurers. And the attraction of the reinsurance market at the moment is twofold. Firstly, how do insurance companies make money? They make it from a combination of investment returns, where they invest their cash and bonds in free float, which is there to pay claims, and then underwriting returns. Now you've seen with the yields and interest rates going up after the last couple of years, the investment returns that the insurance companies are making has gone up quite rapidly. So they've been locking in some good returns there. And secondly, underwriting returns have improved as well. And that's a combination of reinsurance rates going up, in this case for reinsurers, and you can see that on the chart. And that's really a function that reinsurers haven't been hitting their cost of capital up until the last few years. Increased frequency of catastrophe events or secondary perils, as they call it, as well, like wildfires and rainstorms. Has meant returns have been poor. They've pushed up reinsurance rates. And the other critical factor is they've raised what you call attachment points. So the level at which before a primary insurer can claim against his reinsurance has gone up. So some of those, what you call attritional losses from secondary perils that reinsurers have been paying for, and are now being borne by primary insurers, again, a reason why you're seeing insurance rates go up so much. And now you're seeing some of these reinsurance companies make much more attractive returns, and we see that as sustainable, for the next couple of years, and share prices perhaps not pricing that in. On the emerging market front, I sort of touched on this briefly around some of the longer term themes we've liked, like India and Indonesia. But perhaps an interesting tilt here, which is slightly different. Japanese stock market has done very well in the last couple of years, driven obviously in part by some of this corporate governance reform. Also, obviously, expectation of higher interest rates and the impact that has on their markets. You're seeing something similar in South Korea, and as the table on the right shows, you've got, it has been the risk has always been, it's been a value trap. You've got a lot of companies, trading at low valuations. In some cases, make UK financials or UK banks look expensive when you look at some of the South Korean banks. And the government, which has got fairly bipartisan support, has been putting forward some corporate governance reforms here around capital return, around how you interact with shareholders. There's been proposals perhaps to change tax that will allow some of the large conglomerates easier for them to be broken up. Now there's been a bit of volatility around recent elections and the degree to which the opposition parties, support some of the more positive measures that we're seeing coming through here. But the fact that there's largely support on both sides of the aisle in Korea, we think is positive, and so that's where we've taken a position in a couple of banks, Shinhan Financial being one of them. Over the page, sort of small mid-cap opportunities, sort of touched on this. Small mid-caps have obviously lagged to a significant degree globally. Obviously the Mag 7 or large caps generally, when you look within the financial sector, it's the large US financials that have done particularly well, not just due to good operating performance, but also from seeing an improvement in their valuations. And so we've been trying to find some opportunities here where we can find good companies that we like, where we think valuations discount their long-term value. Consequently, we've increased our exposure to the UK here. So we have exposure to two examples: OSB Group, what was called One Savings Bank, IG Group, the spread betting business, and we've got others as well, which don't solely touch on this theme, but have exposure to other themes as well, where we think there's some interesting opportunities. Also, what's here is worth highlighting, this whole interest around alternative asset managers, is the whole flywheel of capital markets reopening this year, with debt markets doing well. You've seen IPO, a few IPOs start to come through. So again, we took advantage and pivoted towards some of the more investment banking banks within the portfolio to take advantage of that, and that's been helpful. On the next slide, I suppose really we sort of just touch on banks and our thoughts there. So as a sort of high level, we are overweight at the moment in European banks within the trust portfolio. We're underweight the US. The themes around that on the right here is you can see the capital return story for European banks is prodigious. We're showing what's coming back to shareholders potentially over the next 3 years, and you're looking on average about a 30% return to shareholders through buybacks and dividends, and that reflects a combination of balance sheets are very strong, and because of the rise in interest rates in the last couple of years, European banks are making much better returns. Their ROEs have gone from single digit to low to middle teens, mid-teens, and that increase in profitability, when the banks themselves aren't growing their loan books very fast, lack of demand, has resulted in them, the only option they have is to either look to return it to shareholders or perhaps use it for M&A purposes. So you've got that good combination of profitability coming up, plus improvement in capital return, and that's led to European banks performing very, very well over the last 3 or 4 years, and we continue to like that. If we flip over the page, one of the concerns why we've been more cautious on the US is this concern, two concerns. One about unrealized losses on balance sheets. This is the mark to market of securities portfolios on banks' balance sheets. So this is the issue around Silicon Valley Bank and First Republic last year. We don't see that as a systemic concern, but it is an overhang. Our bigger concern is around commercial real estate. Now, the issue here is commercial real estate is obviously a very, very large market. The real concerns has been focused on the office, which we highlight on this slide. When you then drill down to office commercial real estate, actually exposure that banks have to it is pretty small, and it's very, very manageable. So we don't see this as a capital issue, but we do see it as a bit of an earnings headwind. Now, saying that, banks have taken significant provisions for their office CRE. So for the large banks, on average, they're assuming 1 in 5 of office CRE loans defaults, so 20%, and they'll lose 50% on that loan. So 50% times 20%, they're taking sort of 10% provisions against some of their office CRE portfolios. Also, for just sort of general provisioning against where we are in the cycle, most banks are assuming in the US, using this example, unemployment will peak above 5%. So again, they've got buffers there. But even though we don't see this as a sort of capital issue for the banks, we just think it's a headwind for the sector to perform until there's more visibility on the outlook for the US economy into next year and commercial real estate markets. Finally, on this slide, we might have shown it before for those who listen to us. It's quite a busy slide. What are we trying to show here? We've taken nearly 30 years of data for global banks. Every single month over that 30 odd years, what was the price to book of global, a portfolio of global banks? So ranging from close to 0.5 times up to sort of 2.5 plus. If you had bought a portfolio of global banks in each of those months, what was then your subsequent 3-year return? And what the chart is trying to highlight is the lower the price you paid, the higher your return, and vice versa. Pre-GFC, banks traded on higher multiples, but that correlation was relatively strong. And you've got an even stronger correlation post-GFC. So banks have more capital, they therefore make less profit, return on equity. But ultimately, if you can buy a bank at a low valuation, the history, if this continues, if the correlation continues, suggests you actually make pretty decent returns. Today, banks are trading between 1 to 1.1 times book. If you look at this chart, that would suggest returns anything from 15 to sort of 50% over the next 3 years. And in a market where valuations generally for equity markets are close to all-time highs, what this highlights is actually there's still tremendous value within bank shares. Just some quick stats overall on the portfolio itself. Again, this just reiterates, even though we think the sector's got a lot of great companies within it, you're buying it, in our case, for less than 11 times earnings. For decent, some cases, double-digit earnings growth coming through, using Bloomberg forecasts. And relative to a market that I think for the MSCI equity world is trading around 18 times, and you've got quite a significant discount and buffer should there be any volatility in markets going forward from here. There's some style analytics there. Just to highlight, we've increased our exposure to some of the value stocks within the sector recently, but historically we prefer, we like the big, good quality financial franchises. If it's a bank, it's got good funding, it's got good profitability. If it's insurance, it's a good underwriter, and so forth. And then to wrap up on the portfolio, again, it is a global financials fund. You look on the right-hand side, you'll recognize the majority of those names. They're very, very well-known financial businesses. Chubb, perhaps a little bit less well-known on this side of the Atlantic. It's one of the biggest insurance companies in the world. It's not the locksmith, but you're getting that broad spread of banks, diversified financials, and insurance companies. On the left-hand side, the exposure, again, reflecting global markets, is very US focused. But again, we've got exposure elsewhere where we like Europe, we highlighted earlier. We've got a little bit of fixed income at the moment, which is giving us some good returns. And the trust being geared has been anywhere from sort of 0 to 13, 14%. It's at the lower end at the moment on the back of the run-up in markets. So with that, I'll just sort of final comment where the trust is today. We're trading, I believe, on sort of 8-9% discount. There's a key liquidity event coming up in June next year. There's 5-yearly tender offers. That's how the trust is structured. 100% of the trust can be tendered at NAV, less a little bit for costs. So what we'd hope, obviously, we can't say what the share price or NAV will be in a year's time, but certainly that discount we'd expect to be smaller than it is today. So that reduces the downside risk, all things being equal, between now and then. So with that, thanks, James, and very happy to.
Great, thank you, Nick. Yeah, cool. And so a couple of just questions about how you run the portfolio first. So there's a very general one about just how you select stocks for the portfolio.
Yeah, it's a really good one. I mean, we have as you'd expect, we have a lot of spreadsheets and models set up, which screen the universe. Some of those might be for different subsectors where we're using different sort of financials or different characteristics of what we're looking for. But for a bank, it's a classic one. What do you want? You want a bank that's got good capital ratios, good liquidity, makes a good return on equity, and yet fundamentally is a good underwriter of risk, and those are some of the, I suppose, key attributes we look for. Now, around that, there's going to be opportunities where you might buy something that's not more of a trading opportunity. But we're just trying to find things where we think, it's balancing that mixture between what we think are good long-term winners, where are going to compound book value or earnings or, whatever it is, around more shorter term, trading opportunities where things are, let's say more in the value basket, maybe not quite, not as good, but where we think the market's overly discounting. So, I mean, two examples recently, we've got holdings in Barclays and Citigroup. Both haven't performed well over the last 5 or 10 years from the point of view of share price, total return, and just operating performance. But we think, we see in both that the bar is low for them to beat estimates out there, and there's an opportunity there to play those. So that's how I suppose it's been, when you look at attribution for the trust, it's very much been driven by bottom-up stock ideas, not necessarily by sector asset allocation or macro calls at the top. And you're just trying to marry up those ideas from around where we're finding interesting opportunities, and then balance that from a risk perspective across the portfolio.
Okay, cool. In terms of the sort of small cap, large cap balance, and you talked about the opportunity in small cap, but is that something you consciously manage?
I wouldn't say consciously. I mean, historically, we've had a lot in some of the US small and mid cap regional banks where we've made some very good money. Consequences, just where we are at this point in the cycle with concerns about commercial real estate. US regional banks are obviously are more sensitive to obviously the economic cycle. So that's one where it's we'll look to buy into those when we're more positive on the where the path of the US economy and commercial real estate goes. But it's more a question of just finding interesting opportunities. I mean, we've gone through a period where it has been a case that the stronger have got stronger, as in that some of the large caps have done particularly well. I mean, if you look at the likes of Berkshire Hathaway or JP Morgan or American Express, they've been consistently outperforming. So actually, it's been a headwind to performance if you've had too much in small and mid caps, and we think that that's possibly turning, but we're trying to be quite selective about it.
Okay. Obviously, a lot of that is outside the UK. Do you try and manage the currency risk, or is it just something that comes with the investment decision?
Yeah, I mean, it does come, the risk comes with the territory. We do, we're not looking to take currency bets, but what we have done is where we've got a big difference between our benchmark, that we might take out some currency hedging, or we might deposit some cash in Australian dollars or Canadian dollars where we got limited exposure at the moment, just to be conscious of those risks. But we're not, we don't hedge back to benchmark. We're not, conversely, we're not looking to take huge risks over and above, where the universe is.
Okay. On the banks, you talked about commercial real estate, potential losses there, but generally, sort of slowing economies and potential rise of bad debts, is that something that is now sort of no longer an issue?
I would say we're at quite an interesting juncture. There's this, if we had this conversation 2 years ago, higher interest rates, undoubtedly good news for the sector. lower negative interest rates, you'd had compressed margins, that squeezed profitability. We've had the reverse of that over, the last few years, especially for European and banks which have done well on the back of that, margins expanded. And the surprise has been the asset quality, bad debts has held up so well. You've had, outside office commercial real estate, maybe a pickup in delinquencies, subprime, consumer lending in the US and other places. Actually, it's been very good. You had what you had in the pandemic, as a lot of banks put in place what they called a sort of COVID buffer, a sort of management overlay. We're going to take a bigger provision because we don't really know what's going to happen. This doesn't, models just don't work for this. And then it turned out actually bad debts didn't jump massively during COVID. So that COVID buffer became a cost of living buffer. And you're at the point now where some banks go, well, we can't continue to have this sort of excess sort of provision set aside. We're going to have to release it. But at the end of the day, if economies, we've seen some better data out this year, so you're not seeing a material deterioration in bad debts at all. But if the economy turns down, then that will change.
Okay, cool. On the reinsurers, I mean, it does feel like the environmental disasters keep getting worse. And I saw a prediction that there's going to be like a record hurricane season this year. I realize that if you have a bad year for losses, the rates go up, so that's good for profit down the line. But if the disasters keep getting worse, do these things make money?
Yeah, I mean it's I don't want to describe it as a Ponzi scheme, but it's an extraordinary where if rates go up and you don't have any hurricanes or whatever, or significant weather-related losses, accidents, these businesses make good money. And if you do, something happens and losses come through, then rates go up even more, and people buy the shares, and they're going to make better money again. Ultimately, I mean, as the chart highlights, this is a very cyclical sector. Higher reinsurance rates leads to higher profitability. That drags in capital. Those rates start to soften and then fall, and profitability falls. People then start, being less cautious about underwriting risk. I mean, the big change that we sort of touched on is that reinsurers have been increasing their reinsurance rates since 2017. And it wasn't really until last year, it was the first year where the companies themselves made decent, returns. And always the unknown is, what's going to happen. The impact of climate change. You've had an increase in frequency, severity is worse. More building on coastal regions or floodplains. I mean, that is being factored into insurance rates, and there is issues in the US about people struggling to get home insurance, and that's a significant issue. And how do you square that circle? That requires politicians and policymakers to figure that one out. But ultimately, if you want private capital, they've got to make a return to make this industry work and provide insurance at a adequate cost that people can afford.
Oh, okay. Now, new is not a name that most people will know. There's a question here. So how do you balance the risk around this? Because it's a fintech and it's LATAM, is that right? Emerging market risk?
That is correct. It's a digital bank in Latin America. I mean, what's extraordinary is it has 100 million customers already. And the concern that we've had, and we have been cautious on it, is with any of these fintech businesses, we don't think it's possible to reinvent the underwriting wheel. It's very easy to lend money. It's a lot harder to get people to pay it back. And there's this joke about buy now, pay later. It's we buy now and charge off later. And then, that industry's had its questions, raised around it. So that's our concern. Ultimately, New is pushing into consumer lending and credit cards. And so far, it's actually proven to be done a reasonable job at it. But that's where the risk is. It is disrupting the market in Brazil. There's concerns the same will happen in Mexico. It's paying much higher deposit rates, but fundamentally, you've got to be cognizant. This is a balance sheet business. It's not like a payments business, like obviously MasterCard, Visa, etc. It is a balance sheet business, and therefore there's risks around that. Now, yes, you can earn fees around all the services you provide to customers, but you've got to be very, very cognizant of that, and that's something that we keep a close eye on.
Can you sort of update us on Berkshire Hathaway, please? The question here is about asking, because Warren Buffett apparently said there's not enough attractive investment opportunities around. But just tell us a little bit about what the attraction is of that stock, please.
Yeah, so I mean, it's the largest stock in our index. I think I can't remember exactly. It might be the fifth or sixth largest company, the S&P 500. It has the biggest balance sheet of any company in the US. Employs 396,000 people, thereabouts, with business, famously across insurance, railroads, energy, utilities, with big investments in the likes of Apple, particularly, but American Express, Kraft Heinz, and so forth. And so it's huge. We've pulled back a bit recently in recent months. I mean, the reason we bought, added to our holding last year is because of the tailwinds we're seeing in the insurance and reinsurance sector. And when you look at Berkshire's results, insurance has gone from generating about 25% of its profits 5 years ago to about 45% today. And it's just made a big investment in Chubb, which are also a big listed insurance company. Buffett made comments that have been repeated about he's struggling to find value. He's getting highlighted that buying back shares here adds perhaps it's less accretive than it has been before, and I think that's reflective of markets as a whole. Markets are by no means cheap, so it's a lot harder to find good value to put money to work. And he's just reflecting that. So in an odd way, you've got a great fantastic franchise here that owns some fantastic businesses. A couple of them have had headwinds around wildfires and litigation and utility business and regulation around that. But it's got a huge balance sheet. It's very, very highly rated. It's sat on $182 billion of cash and T-bills. It's the kind of company you want to own if you go into a volatile, period for markets or economies. In the short run, there's probably better value elsewhere, we think, within the sector, but it's still a great business. So I hope that adds a little bit of color to our thoughts.
Cool, thank you. Just coming back to Korea again.
Yeah.
Obviously, you've highlighted there's a lot of things that are trading on very cheap price to book valuations. There's corporate governance reforms, that's all tick, tick, tick. But do you actually need to be activist or have somebody in there being activist to unlock that value?
Yeah, so it's a good question, and this is obviously the one is this issue around Japan is from Abe's 3 arrows. It's taken nearly 10 years for some of those corporate governance reforms to feed through. It's a little bit different, I think, because it's got broad support from Korean companies themselves, and they're saying that actually you're going to take on board some of these reforms, even if it doesn't necessarily come through legislation. And two possible catalysts, to help that. One is there's going to be an index of companies that meet, the criteria for some of these corporate governance reforms. And I think that's coming up in the next sort of 4 or 5 months. And the plan is towards the end of the year, an ETF will be launched. So there's a push there, and it seems to have good support from certainly the Korean banks that we speak to. So we think it should have legs, but nothing's guaranteed. So we'll see what happens.
Fair enough. Thank you very much. We've covered a lot of ground. It's 11:57, so we've got to wrap up there. But thank you very much for today, especially for stepping in at the last minute. We'll follow with interest and talk to you again soon.
No, thank you, James. Thank you for having me. And
cool. So next week we're talking to the new manager of Majedi. They've had some results this week, so you can have a read of those to see how I've been doing. But he'll kind of update you on that. And then just to flag, on the 21st of June is our next panel show. This is what we've been trying to nail down. So we're going to be talking about big discounts in the sector. And we've got some interesting guests on there already, I think, to talk to you. And then, as I say, we've got a long list of things going all the way through to October. So have a good week, and I will see you next Friday.